Hello, everybody. Welcome to Wiley Solution Walkthrough. This is Accounting Tools for Business Decision Making. This is the 8th edition, exercise 20-17. This is the authors of the textbook are Paul Kimmel, Jerry Wygant, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley & Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. So let's go ahead and take a look at our question before we thank that bus driver. I'll stop with the Fortnite references. I'm sorry. It's just, I can't help it. Okay. So when we look at this over here, we've got Tharp Company operates a small factory in which it manufactures two products, C and D. And the sales results for that last year were as follows. So for purposes of simplicity, the firm averages total fixed costs over the total number of units of C and D products produced and sold. Okay, the research department has developed a new product, E, as a replacement for D. Market study shows that Tharp Company would sell 10,000 units of E next year at a price of $115. Unit variable costs of E are $45. Introduction of product E would lead to a 10% increase in demand for product C and discontinuation of product D. If the company does not introduce a new product, it expects next year's result to be the same as last year's. Should Tharp Company introduce product E next year? Explain why. Okay, so when we get this, what we're going to do is we're going to use a variable costing income statement. And how does this look? Well, we've got over here, we've got sales less variable costs. And then this is going to give us our contribution margin, less fixed costs. And this is going to give us our net income. Okay, so for product C, we sold 9,000 units at 95. Our variable costs were 9,000 units at 50. So my contribution margin for this is going to be 405,000. Okay. The fixed cost, it tells us over here, we're $24 per unit. So this is going to be 9,000 times 24. And so our net income for product C is going to be 189,000. Okay, so let's take a look at product D. Sales here, this is going to be 20,000 times 75. And let's make this into dollars so it makes more sense. Good dad joke today. So I've got 20,000 and 75. For my variable costs, I'm going to have 20,000 units at 40 over here. So my contribution margin is going to be at 700,000. My fixed costs are going to be $24 per unit. Or 480,000. So my net income here is going to be 220,000. So combined, I'm going to have my total sales of 2,355,000, variable costs of 1,250,000, which is 1,105,000, fixed costs over here at 696, and then my net income is going to be my contribution margin less my fixed costs are at 409. So this is where we are today. Okay, this is existing. Okay. Now, if we go through and we're going through and looking at new, okay, let's go ahead and just run in the numbers. So if we go C and then E, right, we've got sales. Same thing, sales, variable cost, contribution margin, fixed costs, and net income. So if I look at this over here, right, in terms of going through and doing this, so for product E, it basically is replacement from product D. So D would be gone. I could sell 10,000 units at a price of 115. My variable costs would be 45. So my contribution margin from this is going to be 700,000. Okay. Now, what it also is saying that this would lead to a 10% increase in demand for product C. So if I'm getting a 10% increase in demand for product C, I have 9,000 units, 10% increase. So my new product C is going to be 9,900. So this is how many units I'm now going to be selling of product C. So this is going to be 95 times 9,900. My variable costs over here are going to be, let's see, this will be 50 times 9,900. And so my contribution margin is going to be 445,500. Okay, so over here, my combined sales, combined variable costs, my combined contribution margin. So that's where we are so far. Now, when it comes to fixed costs, let's see how it's going through and allocating it. So for purposes of simplicity, the firm averages total fixed costs over the number of units of C and D produced and sold. So over here, my total fixed costs are going to be 696,000. So if I'm going through and following the same formula, my units that I'm producing of product C and E, this is going to be 9,900 units. This is going to be 10,000 units. By the way, this is going to be 10,000 times 45. So I've got a total over here of 19,900 units. When I look at this in terms of percentages, it's roughly about 49% and then about 50%. So my fixed costs are 696,000, right? My fixed costs aren't changing. That's really the way it is. And these are being allocated based on units. And does this allocation make sense? Sure. Well, because you're producing basically almost double what this is, that's kind of what it looks like. Okay, so over here, my fixed cost allocation for product C is going to be 346,521. This is going to be 349,749. So over here, so my total fixed costs are still going to be at 696. So my net income over here is going to be 99,249. My net income over here is going to be 350,251. And over here, my combined is going to be 449,500. Now, when we look at this, right, well, C looks a little bit worse. And why does it look worse? Well, it's just because this was selling 20,000 units. And if you're allocating fixed costs based on units, this is driving the amount of that allocation upwards. Okay. Over here for product E, right, this actually has a much higher, seemingly a much higher profit margin. Interesting. Huh. Okay. So this has actually the same contribution margin as the other one did before. Interesting. Okay. But over here, in terms of the allocation, this is just kind of being shifted around. So on an overall basis, this is now at being 449,500. So if we say this, should they introduce product E next year? Explain why or why not. You say, well, by introducing product E, our overall combined profit or net income increases by 40,500 as a percentage increase, right? This is going to be 40,500 divided by 409. So we're seeing about a 10% increase in our net income. Okay. What does that mean? If I take 409 times 9.9, I then add these two up, and then I'm getting to my new net income. So by adding in the new product, or by swapping out the product, I'm also going through and increasing my net income. Now, the other thing too is that, well, should we go through and do this? Well, if we do a long-term market study and we find that product E has greater longevity than product D, then we may want to do it anyways, because if product D is going to start declining, we may want to get a jump up in terms of our manufacturing, or something along those lines. So that's what I would kind of go through. And, so should they introduce product E next year? I would say yes. And the reason why is net income is increasing by 9.9%. But before we go, I might have to redo this video, so it's going to be exciting. Let's look at the solution together. Okay, so right over here, we've got net income of 409. Over here, oh, wow, we did it right. Okay, there you go. We got over here, we got net income of 449,500. So again, should be increased by, there you go, by 40,500. Now, if it were me, I would also, you want to say that, you want to say because due to the increase, you also may want to give some more qualitative, you may also want to give some more of a qualitative explanation, which was what I was kind of sharing with you earlier, like we're going to modernize by introducing that new product and it's going to be great again, right? So we're going to make accounting great again and it's going to be amazing. So there you go. In any event, I want to thank Wiley, as always, for allowing me to use their material. And please don't forget to like and subscribe if you need solutions to any other kind of questions. My real focus right now is on financial, managerial, and intermediate. But if you have other questions that you want me to go through and do, and if it's something I can do pretty easily, meaning I'm lazy, I don't have to go through a lot of research, but if I'm teaching, I can might be able to answer your question. So in any event, thank you, and I'll see you on the next video. Have a great one.